This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me John Rubino, well-known author and publisher of the website DollarCollapse.com. Good morning, John. Welcome back.
Good morning, Gord.
John, I want to jump right into China, Russia, and the end of the petrodollar. And I've been writing and talking about here for the last couple of weeks about how September was an absolute seminal month, and I think it'll go down in history, not just because of unlimited QE and uncapped OMT in Europe, which in itself is a seminal event, but more so because of what's happening with the dollar and China agreement that it just recently released with Russia, that it's now going to exchange oil based on the yuan and not through the United States dollar. And just for our listeners that may not be aware, the only way you can buy and sell oil in the world has been through the exchange of U.S. dollars. And it's denominated in U.S. dollars. And the only people that have ever objected to that were Libya, who was quickly removed, and Saddam Hussein was quickly removed. And matter of fact, Saddam, 90 days after he decided he was going to take euros or gold for it. So the United States has a monopoly on the fact that you can only buy oil denominated in U.S. dollars. When, in fact, you can exchange it in some other currency, then there's not the same need for that same amount of U.S. dollars to be out there. And therefore, as the world's reserve currency, those dollars will be returned to the United States because there's not the same need. That has profound implications. And that's what's going on in China with all of its bilateral agreements that it's now lining up around the world to, in fact, exchange and not to use the U.S. dollar, I think has profound implications.
China and Russia are rising powers, and they would both like to dominate their neighborhoods. But they can't do that while the U.S. has the world's reserve currency, because we can basically create as many dollars as we want to and use it to finance a basically untouchable military empire. And so if China and Russia are going to become superpowers in their own neighborhood and be able to intimidate people in the rest of the world, which is what they'd like to do, they've got to deal with the old superpower. They've got to push the U.S. out of our spheres of influence in their neighborhoods, and the dollar is standing in the way of that. And that, as you said, the reason the dollar is the world's reserve currency is because we cut a deal back in the 1970s with basically Saudi Arabia, but also the rest of OPEC, to trade oil only in dollars. And so everybody in the world who has anything to do with oil has to hold huge amounts of dollars in order to buy and sell oil.
The deal we got was, we'll keep you in power using our military force, and for keeping you in power, we expect you to trade only in U.S. dollars, and in fact to keep your reserves and your money in U.S. dollars, whether in the United States or abroad.
Yeah, which is that's why we're so serious about the Middle East now. Anytime anything happens there, we are there. You know, we need to protect the flow of oil, and we need to protect the petrodollar.
Everybody confuses the Middle East of being about us wanting the oil. That's important, but that's not the real issue. It's about demanding the oil is transacted in U.S. dollars.
That is true, because protecting the flow of oil is important, but it's going to flow regardless. You know, the countries in the Middle East, that's their only export. And so regardless of who's in charge over there, they're going to export oil to the extent that they can. And it'll find its way to the global marketplace where it's basically fungible. You know, oil from Iran is the same as oil from Canada and oil from Saudi Arabia. And, you know, it all affects the price in the same way, no matter where it comes from. And so we would still get oil, even if we weren't involved in the Middle East at all. But it wouldn't be traded in dollars, as you said. And that affects the value of the dollar dramatically. So what we're seeing now, to get back to China and Russia, is efforts on the part of a lot of countries in the world to break free of the petrodollar and to start trading for oil and other things in their own currencies. And they've got some deals lately that have been really, really important, but that have gotten very little press. For instance, China and Russia recently decided to start using their own currencies when they trade with each other. And these are big trading powers. We're talking a lot of money here that used to involve dollars in some way. And now it's going to be rubles for yuan back and forth. And also China has agreed to currency swaps with, among others, Brazil, the United Arab Emirates, and Australia, in which their central banks trade currencies and then have those currencies on hand to trade goods and services. Again, no dollars needed for this process. So they're completely bypassing the dollar as a reserve currency. And India and Japan have done the same thing. Very big currency swap that they can use for bilateral trade without bothering with dollars. And, it goes on and on. India and China and Russia are trading with Iran now in violation of U.S. sanctions by using their own currencies and by bartering goods and services for oil. And Africa, the final frontier for natural resources, a lot of African countries are trading with China in yuan instead of dollars. And you add all this up, and it means a dramatically lower demand for dollars out there going forward. And these are just the beginning deals in what could be a process of a huge expansion in the yen and the yuan and the ruble as internationally traded currencies. And if the dollar is just one of 4 or 5 major currencies that are used for international trade, that's a huge, huge change for us. Because right now, the dollar is about 60% of central bank reserves out there. But if the dollar is just one of 4 or 5 currencies, that total might legitimately go down to 30 or 40% of central bank reserves in the very near future, which would mean a huge amount of dollars dumped on the open market and lower demand for dollars going forward. And, supply and demand. If the demand for dollars goes down, then the value of the dollar goes down. And we could see a dramatic drop in the value of the dollar in foreign exchange markets, and definitely versus precious metals like gold and silver going forward, which means higher inflation, higher interest rates, and basically a death spiral for the global military empire / welfare state that we've built up over the years. And that's all coming. And so these deals deserve a lot more press than they're getting.
The way we won the Cold War was we forced Russia into an arms race that they couldn't afford, and we beat them. But we could do that because we were economically a powerhouse, so we could effectively, if you would, outfund them to do it. I believe that BRIC, China, Russia have taken a different strategy in the global geopolitical and have decided the Achilles heel for the United States is going to be its ability to pay for its war machine. And the way to do it is to undermine the reserve currency that the United States has the monopoly on right now. And as bad as it is and as large it is just with the oil trade, China has got these relationships, as you mentioned, but have established them with just about all the countries in South America. They have been working in Africa here for close to 5 years. I go through every single country, small numbers, but they all begin to really add up. We haven't been paying a lot of attention to them. I've seen it in Canada with the amount of natural resources that they're buying and how they're going to exchange. So you take all of that and then overlay it with this point too, John. The United States used to be the largest exporter in the world and therefore demanded that goods be paid for in the United States dollars. So to buy U.S. exports, you export a product, you need it to have U.S. dollars or keep them. We're not the world's biggest exporter anymore. We've fallen dramatically. So you've got this massive issue with oil. You've got this massive issue the United States is not an exporter. Then you've got all of these other smaller countries deciding that they have goods and services that more or less are coming out of Asia, and that's their better trading partner. So this will go on until it won't go on. But you can see that it's building, and when it breaks, it'll break very quickly. And the last point I'd make is we don't have inflation, but the difference between hyperinflation and inflation is when people lose confidence in a currency. It isn't food prices go up because, it's supply and demand. Usually when they really go up is because the currency itself just suddenly breaks.
Yeah, it's like the old quote from Hemingway, so someone goes broke slowly at first and then very quickly. That's what will happen to the U.S. We'll have central banks around the world selling treasury bonds, and which would push up the interest rate on treasury bonds, other things being equal. And then the Fed will have to buy them with newly created dollars, which nobody's going to want in the world, or fewer and fewer people will want. And so that will create a process that will become visible. And once it becomes visible, everybody heads for the exits at once. You'll see everybody in the world who is a large holder of dollars trying to convert those dollars into other things. And a lot of that will be U.S. assets. So you'll see these dollars, there's something like 7 trillion U.S. dollars out there in the world outside the country. And those dollars will come home via people in other countries trying to buy U.S. assets, which will cause inflation domestically to spike. The price of everything in the U.S. is going to go up, while wages will be going down in real terms because we're getting paid in dollars, which will become less and less valuable relative to stuff. And so it'll be the worst of all possible worlds for U.S. citizens if this plays out, in that scenario where we're making less and less money in real terms, and the value of the things that we have to buy, especially the necessities of life, will go through the roof. And that'll take us back to the whole police state thing. When civil unrest breaks out because of the loss of the dollar's value on foreign exchange markets, then we get the chaos that you and I have talked about in previous sessions.
What could stop this from happening? What could throw a monkey wrench into it? What could the United States do, or what kind of events could happen to either slow it or reverse it?
Well, chaos in the rest of the world would give us some breathing room. We've seen that lately. The Eurozone blows up and the dollar gets stronger. And there's an awful lot of stuff going on in the world right now that could lead to the kind of chaos that actually makes the U.S. look like a safe haven for a while. So we could have years and years of money flowing into treasury bonds because people are even more afraid of what's happening out there in the rest of the world.
So a large geopolitical event, a false flag that suddenly puts the fear of God in everybody, of greater instability, would in fact protect the United States.
It could be something real, or it could be a false flag. And, false flags, that's a subject for us to spend another hour on sometime, because I don't think most people realize that we've been doing things like that for centuries. The U.S. has gotten into almost the majority of its wars via faked incidents, where we basically make up an attack and then use that as our pretext for getting into some war that our leaders would like us to get into. And now, we're seeing something interesting out there with the news stories about Iranian cyber attacks on U.S. banks. And, leaving aside the absurdity of Iran's hackers being sophisticated enough to break into Citigroup and JP Morgan Chase and cause trouble. You got to wonder why they would do it if it was something that we could detect. So, it's possible that that's going to be the next false flag. Maybe we have a couple of big banks get taken down by internal computer problems, and we blame it on Iran and use that as a pretext for attack. Gordon, once you go down that rabbit hole, you come up with a lot of very disturbing conclusions, and you never know. But I think we should keep in mind our history as a country pulling stunts like this before we believe anything we see in the press.
Well, there's another old adage that future wars are never fought on the weapons of the last war, and they're always fought differently. And, my experience in France looking at the Maginot Line and how the Germans just simply went around it with a highly mobilized army as opposed to the First World War of trenches. And we can go through all of that. And so, my inkling is there will be an event, and it will be serious, and it will put the fear of God into everybody, and it will therefore allow this to go on longer. But in my opinion, that war will be something in the area of a cyber attack.
Yeah.
And by cyber attack, I mean a very major disruption to the financial systems that in itself will start to cause problems. So, for example, if your ATMs weren't working, just think would it stop? Or if money wasn't able to flow, so therefore goods and services wouldn't flow. The 2008 all started. The issue was trade dollars weren't available on shipping containers. That's what started to pyramid this whole thing. So if you could disrupt that under the auspices of apparently bad people doing something from a terrorist standpoint, you've got the auspices of which the government could make all sorts of very unilateral, almost, in fact, I would care, unconstitutional moves to protect ourselves, to keep the systems operational, but at the same time would push out the problems we've been talking about for another period of time and would counter this whole issue with the U.S. dollar.
Yeah, that's what's so scary from an investing standpoint now is you don't know whether fundamentals win out, which would mean sooner rather than later things start to fall apart, or if the various kinds of manipulation that are going on out there succeed in one way or another and stretch it out for another year or another 5 years or whatever, and in which case, if you're betting against the current system, you lose. And I think that's part of the strategy too. You know, they want to keep speculators at bay by raising the cost, raising the risk of speculating against the current system. And you see that in a lot of different markets where crazy things will happen at 3 o'clock in the morning when the markets are very thin, and speculation is that it's various big players entering the market and trying to punish speculators in order to make it less attractive to bet against the system. And, you know, we could see things like that too. And that's part of the process where holders of gold and silver may be made to suffer in the short run because they're betting against the dollar. And the powers that be don't want us to do that. So yeah, you know, the number of crazy things that could happen and the number of cross currents are so huge that it's impossible to talk timing with any kind of certainty here.
We do here at GordonTLong.com a tremendous amount of technical analysis, John, and I can see all of that in the trading charts, which you're just talking about. You know, the volumes on the market have been going absolutely down the rate that the market has been going up. And it's because of the 70, 90, I would say 70% of the market now is on a daily basis is simply algo traders. And I say that not program traders, but algo traders that are in the milliseconds. Then we have program traders, which are all program driven. And I would guess to say that the traffic now is well in excess of 90% of the daily transactions. If something happens, it will be in the ilk of a flash crash.
So Gordon, that's actually a question that I'm wondering about. How do you do technical trading in a market that is manipulated like this? I mean, when you got Goldman Sachs's trading desk able to see the 50-day moving average and the 200-day moving average and know that there are people on the other side of that bet and they have the ability to push markets through these technical trading levels and cause all kinds of other stuff to happen. You know, how do you apply technical analysis to something like that?
It's a really good question, John, because it's changed dramatically in the last 6 years. A few years ago, you could use, you know, the old standard Bollinger Bands, MACDs, Elliott Wave, GON, all these various technical studies, and you could actually predict and you could see where the markets were going and you could trade to it. Those days are gone, they're history. That's why the whole area of the day trader just doesn't work anymore. So what's happened now is the vast majority of all of these systems are program trades are still reliant on a lot of, I would say about 8 or 9 basic systems. I'll pick Elliott Wave principles as an example, GON analysis as an example. But if you look at it that way. So what happens is all of these computers are programmed differently, but some of the fundamentals are all the same. They're at different weightings. So what happens is when the markets move, these computers end up correlating and they start moving together in the same sequence. So the trick has become not so much to trade the little moves, is to know that when you hit a trigger point, and you'll know when the trigger point starts to happen, the market will take it to a very specific point, whether that's up or down. You cannot know whether it's going to go up or down. That's what's different. It used to be you could determine that on probability. Can't do that anymore. But you do know this, that once it passes a trigger point that it's going, and it tells you it's going up or down, you know what the zone that it's going to. And that gets into options where you're doing straddles and butterflies and spreads. That's why the derivatives marketplace is in fact very much controlling this market. So I know I have a joint venture with Triggers Media, and the trading numbers that they're being able to hit are just stunning, John. And it's because they're taking macro analytic analysis that we do here, and they marry it into the technical analysis to come up with these high trading zones, and they're just nailing it, absolutely nailing it. Now, how long that'll last, don't know, because these markets just keep changing. But in this particular 1 year, 2 year window, it seems to be the new thesis for trading. I hope I wasn't too long-winded in trying to answer that question.
That's interesting, because I've been wondering about it. So is what you're saying that you no longer trade the instruments themselves, but you're trading volatility because you know what band something is going to trade in, but you don't know whether it's going to go up or down. So you're betting on the magnitude of the swing?
Yes.
Okay.
But you can be very close with the targets that it'll go to. Technical analysis will tell you what the target should be. It's just that when they come in and they make the move, you just don't know which way it's going to go, because the volumes, when they start to make the move, are in the after hours markets. And they're very, very clear. And it's just almost totally random. But once they make the move and the money starts to flow, you know where the end product typically is going to be, end point is going to be, before it finds a support or resistance. That's completely different than it used to be.
Oh yeah, yeah.
That and in effect, that's why these guys are able to say the major banks, no trading losses in 90 days on their quarter in their 10Qs and 10Ks. That's what they're doing. And so everybody that's caught in the middle, the fund managers, et cetera, the traders, they're just scalped absolutely regularly.
Well, the big banks are engineering these moves, so they don't even have to play them. They just make it happen.
They're risk-free to them.
Yeah, fascinating.
John, this system works until it doesn't, and that is when it breaks these continuity. And so what I'm waiting for is a point at which a lot of these hedges just won't work. Collateral damage, something will break. And so when the market moves, I can see days where it'll be 900-point days down, collar limits every time they try and open it. Because that's what we're really setting ourselves up for. I'm not saying it's imminent. I'm just saying it's almost built into the system now.
Yeah, and see, the question on days like that, I agree that something like that is coming. But the question is what happens to precious metals on those days? Do they get sucked down, or does everybody flow into the final safe haven, the only kind of money that still works? And do you see gold up $100 an ounce on a day when the Dow is down 1,000? That would be an interesting day.
Yeah, I personally expect to see gold doing $100 days sometime in the future. And frankly, silver at even a bigger percentage gain. But it will be short-lived. Not that it isn't the potential, but the government will then step in to go after these hard currency terrorists.
Mm-hmm.
Who are disrupting the market with their speculation.
Sure, and that's a guarantee that
that's a given.
Should be, and because they'll intervene in the stock market too. We might end up with the government directly buying stocks. The S&P 500 across the board or something like that.
The financial markets, John, have moved from an era where they were for investors. Mm-hmm. Today, the financial markets have moved. They're for gamblers because you're being forced into unbelievable risk, and you really are gambling. At best, I can say you're a speculator. The days of investing where it's going to be on profits and the ability for a company to grow its earnings, all the markets move together, not just the equity markets. And they're all moving at such big gains and losses when they do move. The profits in many ways are becoming secondary to it. So it's questionable today. I believe we're in a high risk marketplace. And sometimes when you're in that, the best thing to do is to stand aside. But people can't. Because they've got all of their pension plan money all tied up in the markets. Unknowing to them because they're pension managers. No. So when this hits, there'll be the greatest transfer in wealth in history as it's moved from maybe not your personal account, but from your pension account into private hands.
Yeah. And
so the markets will be crushed, and then you'll say, well, I wasn't in the market, but all of a sudden that pension you thought you're going to get isn't there.
Yeah, and then we're back to civil unrest. And
well, that's
all roads lead back to dictatorship.
That's the bigger issue, and if you doubt that for a minute, then I need somebody to explain to me why there's a $700 trillion swaps marketplace when the world's economy is less than $52 trillion. So how can that be? And I understand the whole concept of netting, but when you get inside of these between the countries, it's not possible. So there's huge games going. That any moves in interest rates, and we've just talked about interest rates will move based on the currency, and whether there's strength or weakness in a currency will dictate those interest rates. And we've just talked about the magnitude of the exposure we have on currency right now, or at least volatility in that currency. And you get outside of bandwidths, then you've got the kinds of issues I'm talking about, and you'll get flash crashes, etc. This is an incredibly high risk marketplace. And it's not, and people need to give an awful lot of thought to it right now.
Yeah, actually, something interesting is happening today, Gordon. The Dow is down 170 points, and gold and silver are down, but gold stocks are up. The HUI index is up, not a lot, but it's going in the opposite direction from stocks. So we are seeing money flow out of, industrial and tech stocks and into the miners.
I'm expecting, John, and the gold miners and the juniors, et cetera, gold miners have been lagging for quite some time and just haven't been participating. But I'm personally looking for them to be a winner in the next, if there are winners in the foreseeable future, but not quite yet. We've got a little bit more pain in personal. John, we're past our hard line here, but just another great discussion. Really enjoyed it. Could you tell our listeners how they could learn more about your work, your writings, and your website?
Sure. I run dollarcollapse.com, which is a blog/news aggregation site that covers a lot of the stuff we talked about, updated daily.
John, until we talk next month, all the best.
Great. Thanks, Gordon.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.